Do you wish that all things wealth and finance were much easier to understand and not presented by a bunch of beige cardigan-wearing geeks? Welcome to the Clever Investor Podcast, where we're dishing up the easiest to understand finance program served in bite-sized chunks, so your brain will thank you as your knowledge grows. Hosted by the brilliant Owen Taylor, a multiple award-winning expert with a glorious knack for explaining the complex world of wealth in the simplest of ways.
Hey Clever Investors, and welcome to another show. One of our listeners contacted me a while ago with a question. They had already got some investment properties in their personal names, and she said to me, can we do a topic on what trusts are and why would you use them? So I grabbed my phone out of my pocket and I lined up a time to talk to somebody who I know and have trusted for so many years. His name is Dominic Myssy. He owns and runs his own very fine accounting business. He is very much a specialist in this whole area of trusts, and he's one of those people that what he doesn't know about it, you really don't need to know.
Hello?
Dom, it's Owen.
Hey, Owen, how are you?
I'm good, mate. Can I ask you a question?
Definitely.
What is a trust?
So a trust is a legal arrangement and that dates many centuries, and a lot of people would actually be in a trustee-beneficiary relationship without knowing it, and I'll explain that. But effectively, a trust is a legal arrangement whereby a trustee is holding property or assets or has some sort of obligation to a class of beneficiaries. So a really common example of a trust relationship would be if you had a property and you got a managing agent to lease it out to a tenant. The tenant would pay the rent into the managing agent's trust account. People will be familiar with that. And then that money would then be held for you as a landholder. So in that situation, the trustee would be the managing agent, the real estate agent, and the beneficiary would be the owner of the property. That's it in simplest terms. Most people come across it when I keep using property, but that's where you commonly would come across that. You're buying your house, put money into a trust account for a solicitor, and then they're the ones that they're holding the money to you.
Right.
So that's quite simply what it is. There's the two main roles. There's a third role, which is called an appointer, but where the appointer can appoint or remove the trustee. But again, the trustee then has to act in accordance. So there's a trustee-beneficiary relationship, and the trustee needs to act in accordance with the rules, which is what we call the trust deed.
So why would somebody use a trust outside of being a managing agent for a property?
Yeah, so that's just a familiar commercial situation, which is just kind of helps solidify people's understanding of what a trust relationship is. Why you would use it, I mean, there's a plethora of reasons, but we kind of narrow it down into two main reasons. So one would be for asset protection, and the other reason would be for tax minimization. There are other reasons as well, whereby somebody may not have mental capacity. So then, or a common situation may be, somebody passes away, children are minors, then the estate or assets of that estate are then being held on behalf of the children. That's the trust. But generally speaking, it's for asset protection and tax minimization. So how a trust works is that things, as a beneficiary, things are being held on your behalf. You can receive a distribution from that trust, so you can enjoy any income or the asset itself, but you don't actually own the asset directly. So if something were to happen to you personally, if somebody were to pursue you or you were to go bankrupt, then you had to list all your personal assets, what's being held in trust for you will not count towards your asset pool. There are anti-avoidance provisions, what we call clawback. So, if you try to manipulate things and show you got less assets by transferring to a trust, that can be clawed back. But generally speaking, anything held in trust for you isn't held by you personally. So that's really useful when you've got people that are, generally in business. They act as directors maybe they're in highly litigious professions, such as being a surgeon or a doctor or a lawyer. So there's very strong asset protection aspects to it. The other side, which is kind of the quote-unquote sexier part, which most people like, is the tax minimization. So asset protection is sort of like insurance. It's an intangible benefit. You only realize it when you need it, when you get in that situation, which shouldn't be common. But tax minimization, you kind of have, depending on your circumstances, you'd be seeing the benefits of that more regularly. So with a trust, you as a contradistinction, if you've got an asset held in your own name versus holding in a trust. If you have an asset in your own name, or you hold it jointly with a partner or whatnot, you've got a fixed entitlement to any income and capital from that asset. So again, I'll use a property because it's just the easiest example. You've got a property, you own the property in your own name, or you and your partner own property in your own names jointly. The property generates rents. Say the rent for the year is $20,000. You, for tax purposes, would have to report $10,000, and your partner would have to report $10,000. And that's a fixed entitlement every year. That will remain the same. The only way to change that would be to change your interest on title, and that would then incur capital gains tax and stamp duty. It's a bit of an administrative nightmare. And likewise, if you were to sell the property, any capital gains would have to be split 50-50. So, you could be on title 75-25, but let's just say generally it's held joint tenants, so 50-50. So whereas if a property were to be held in a trust, depending on what the trust deed says, before the end of the financial year, the trustee could determine who receives a trust distribution. So most common forms of trusts, we probably should have said this from the start, there are three types of trusts. One's what we call a discretionary trust, where the trustee has the discretion to distribute income and capital. And most commonly, colloquially, they get called family trusts. They're not all family trusts, but that's what a family trust is. So there's a discretionary trust. Then you have what we call a fixed trust. So there's a trust relationship that, for example, you and me might be part of this trust. I own 50% of the interest of that trust. You own 50% of the units of the trust, and our interest will be split accordingly. And there's what we call a hybrid, which isn't used very much today. The HO is not a big fan of them, but which is a mix. There's a fixed element and there's a discretionary element. So for tax minimization purposes, I'm generally speaking about a discretionary trust, also commonly called a family trust, where a family trust election has been made. So with a discretionary trust, again, I gave the example, the trustee holds assets and income on behalf of the beneficiaries. However, with a discretionary trust, the trustee would allow the trustee to determine who to distribute the income and capital to. So from a tax perspective, you might get to 1 year, it might be might be advantageous to put the majority of income to Dominic. But in the next year, for whatever reason, maybe Dominic's made a capital gain or is in the highest tax bracket, and Owen is also part of this trust, and Owen is on a lower tax bracket or has taken a year off. The trustee may determine to then distribute the majority of income to Owen. So, and that's a really simple example. When you look at when you make a family trust election, which is a tax election, the family trust allows you to distribute income to that what we term a test individual, that test individual's family group. So we call them like bloodline descendants, so up and down the line. So if it was my family trust, if I was the specified individual in the family trust, then it would be anyone related to me in the capacity of a grandparent, parent, uncles and aunts, spouses, children, spouse of children, grandchildren, spouse of grandchildren, and so on, and other entities that are also controlled. And it allows for future generations as well. So obviously, once you make a family trust election, you really, really expand your pool. I gave you an example where it's just you and me, but a lot of the time you might have a situation where you've got a family group, mum and dad are working, and then you've got children, maybe the adult children, the 18 plus. Somebody might be taking a gap year. Somebody might be at university, or working part time, or just started a graduate entry level job, which is on lower pay. So these give opportunities to be able to utilize the various marginal rates of tax, and not always have the income and capital concentrated in one or two persons' hands. So it's a bit of the tax the tax aspect is there's a lot of scope to work with. It gives you a lot of flexibility. At the very least, you've got an option as opposed to, and you may not use it in one particular year, but at least it's open to in future years you might use it. Whereas if you own a property in your own name or an asset in your own name, you've got a fixed entitlement to that unless you vary the interest, which, like I said, is not a simple thing to do.
Are there any restrictions on what property you can buy or what the trust can have?
The key feature of a trust is that the trustee needs to follow what the trustee states. So, like I call them, the rules. So if a trustee allows something to be done, then it can be done. If a trustee says something can't be done, then it can't be done. So you always follow what's prescribed in the trust deed. So there are certain trusts where, most notably, for example, special disability trust, you've got adult children. So parents, have children that are disabled. They want to make sure those children are looked after when they pass on, and when those children become adults, and they might have some sort of condition, whether they have mental capacity. So a special disability trust is set up whereby the trust deed would state, dear trustee, because typically in this situation, the trustee won't be the same as the beneficiary, because it can't be. It might be a trusted third party, a lawyer or something like that. Anyway, and to ensure safeguards, the trust deed would say, beneficiary A who is disabled, income of the only assets that could be invested in are X, Y, Z. The only income that can be generated is X, Y, Z. The only expenditure could be X, Y, Z. So just to make sure they safeguard the assets. But generally speaking, you can make your trust deed as broad as you want or as restricted as you want. It just depends on what your intentions are with that arrangement.
This sounds like a wonderful, for want of a better word, a wonderful tool to be used. Obviously, we can all jump on Dr. Google and go and Google all of this till our heart's content. But who is the industry professional that is going to advise someone and I suppose help them manage it?
Yeah, very, very good question. So yeah, like with anything, there's a myriad amount of information available online. And like with anything, there's good information and bad information. And the important thing is that you have somebody that is across all the different types of information that's out there and can make sure that it's suitable for you. So it's ultimately, a trust is a legal instrument. So you need a lawyer preparing the trust. So there needs to be, a lawyer that's prepared the trust deed. However, you also, and it could be the lawyer, you also need to have a professional that understands all the different roles, understands the interaction with the tax system, and so brings it together and makes sure it's the most appropriate thing, structure. It's a very common area in which we assist people with structuring and restructuring is kind of a specialty in our firm. We work with lawyers that make sure they produce robust and legally sound trust deeds, but so we would also instruct the lawyers on the different types of roles after, once we've consulted with the client. Generally, it is a lawyer. You need to have a lawyer who's experienced in trusts and also has a tax understanding. Obviously, we do it because we know the tax. We know the tax system, and we've got a very deep understanding of trust. I'll give you an example. You can have a trust where the trustee could be an individual, and the majority of trusts in Australia are set up that way, and it's cheaper. You're saving yourself like $900 from having to set up a company to act as a trustee. But all the asset protection issues and administration issues from setting it up that way, it's pretty crazy. So you need somebody who actually understands how trusts work. Making sure they understand who the appointer is, understanding all the roles. Otherwise, if it's set up incorrectly, then you actually don't have a trust. So, there are things that we do in the trust. If for certain states in Australia, if a trust doesn't have a certain clause, the trust is considered a foreign person, and there's a foreign person land tax and stamp duty tax applicable, which is quite sizable. If you've got the wrong person who's the trustee or the wrong person who's the appointer, and the deed, depending on the deed, that person can be disqualified from being a beneficiary. And then if you make a distribution to that person in the future, then a trust relationship has never existed. So we've had situations where we found trust clients that come to us, bought a trust, and we've realized they made an illegal distribution as per the trust deed rules. Mm-hmm. And the last 7 or 8 years, there's been no trust relationship. So that was like a 47% tax bill for the client on each of those years. And just there's no legal relationship anymore. So it's like anything. We would always obviously we have a biased opinion, but you go to the person who's experienced in that area. So we wouldn't recommend you try doing it yourself. But there are like lots of online providers. But yeah,
there's a YouTube channel for everything. But
there is.
In summary, then you could go and do this on the cheap, but you are very much going to get what you pay for, and in the long term. And this is probably not a technical term that you use a lot, but it can come and bite you on the bum if it's just not done properly and for the right reasons.
Correct. I mean, it's one thing to have it. It's one thing to have the correct structure, but it's important that clients. We're really big on education. It's important that clients understand what they've got in place. So yes, you might go online and set up the trust correctly. Which that's great. I'd argue there is, trust law, evolves year on year. I'd argue there'd be things that might be missing, but you could go and set up correctly for your purposes. But if you don't, as part of the setup, working with a professional, you need to understand how the trust works, so then you can actually maximize the benefit from it. So we've got clients who've come to us and didn't realize they could do certain things with their trust. Not understanding that you can make a family trust election or distribute to other people that aren't actually specified as listed as a specified beneficiary, and then they could have saved a whole lot of money in past years. So obviously, the saving they got on just doing on the fly with the wrong person was completely outweighed by all the losses not being able to use the trust properly.
Yeah, never be scared to use an industry professional. Thank you so much for sharing all of that knowledge. And I know that, quite honestly, you've only sort of touched the tip of the iceberg on all of that. We'll probably need to speak to you again sometime. But thank you so much for sharing that on the Clever Investor today.
My pleasure, Owen, and thank you very much for having me.
Thank you ever so much.
No worries, mate.
You have been listening to the Clever Investor Podcast, proudly sponsored this week by Blue Wealth Property. Are you ready to start a new investment journey? Get in touch with the industry leaders, Blue Wealth Property. Blue Wealth have a proven track record in using research to identify growth markets, and Blue Wealth have supported thousands of Australians to buy the right property in the right market at the right time. Go to bluewealth.com.au.